Welcome to Breaking News to Trading Moves.
Hello.
Today we're focusing on a recent market event and really just looking at the fallout. We're going to use the material we have to categorize who stands to benefit and who, now faces some heightened competitive pressure.
And our mission today is to zero in on a performance announcement from one of Latin America's largest and certainly most watched digital finance companies, Nubank.
Right. And it operates under its U.S.-listed parent, New Holdings. That's ticker NU.
Exactly. And this single earnings report, it does more than just detail one company's success. It gives us a really vital piece of evidence about the health and, frankly, the future trajectory of digital banking, especially in emerging markets.
So the core event is that third quarter earnings report from NU. And the summary, the big takeaway, is that they delivered record Q3 numbers. These results were strong enough to just fly past the expectations from market analysts, and it confirms this pattern of accelerating growth paired with some pretty impressive efficiency.
It feels like an inflection point for the industry conversation. So we're going to start by dissecting the precise financial metrics that validate this performance for New Holdings.
Okay.
From there, we'll clearly categorize the three groups of market participants who are, structurally positioned as beneficiaries. And then, crucially, we'll pivot to the three categories of incumbents who are now under greater operational strain because of this accelerating success.
Let's start with those fundamental figures, the ones that caused such a reaction in the market. When we talk about neobanks, there was a long period where the core investment idea was questioned, right?
Oh, heavily questioned.
Yeah. Can these digital-only entities actually achieve large-scale, sustainable profitability? Or are they just destined to burn through capital forever while they chase growth? These Q3 results seem to provide a pretty definitive answer.
They absolutely do. The figures demonstrate both scale and, I think, operational effectiveness. Net income for the quarter climbed to approximately $783 million.
And that figure, that's not the income of a startup.
No, not at all. It represents a financial institution that has achieved full commercial maturity. And what's maybe even more telling than the sheer volume of that profit is the rate at which it's growing.
That growth rate is what analysts are always looking for when they're trying to spot acceleration.
It is. And what we're seeing here is that net income was up almost 40% year on year. This pace of expansion is what caused the results to sail past analyst predictions.
Wow.
And alongside that net income expansion, revenue also grew robustly, about 39%.
So achieving that level of top-line expansion while at the same time extracting substantial profit, it suggests that the operational model isn't just mature, but it's getting more efficient with every new customer they add.
That's the key.
A 40% annual growth rate in net income is a powerful testament to successful execution. But there is one metric, it's often seen as the ultimate measure of a financial institution's health, that really dictates the market reaction. That's return on equity, or ROE.
The return on equity is the gold standard metric. It measures how effectively management uses the capital that shareholders provide to generate profit. And for Q3, New Holdings achieved an ROE of about 31%.
31%.
That's the key figure. That's the number that changes the whole conversation around the viability of digital finance in emerging markets.
Let's just pause on that 31% ROE, because for anyone who tracks global finance, that number is, well, it's remarkable. To really appreciate its magnitude, we need to frame it against the traditional banking landscape that it's disrupting.
Right.
So if you look at the established traditional Brazilian banks, the very companies NU is taking market share from, where do their typical ROE figures land?
And that comparison is absolutely essential to understanding the structural threat here. Historically, successful traditional banks in the region, names like Itaú or Bradesco, they might target an ROE in the high teens or maybe low 20s.
So maybe 18 to 22% in a good environment.
Exactly, depending on the cycle and, of course, regulatory requirements. So when a purely digital low-fee competitor like NU posts an ROE of 31%, it doesn't just beat the benchmark.
It completely resets it.
It completely resets it.
So the core insight here is that the digital model isn't just a little bit better, it's vastly more capital efficient. It proves that you can run a profitable, large-scale financial institution that is simultaneously high growth and low fee.
Precisely. This 31% ROE provides undeniable evidence that app-first banking in emerging markets can achieve both rapid expansion and superior profitability. The long-standing skepticism about digital banks was, it was rooted in the fear that massive customer acquisition costs or the constraint of a low-fee model would prevent them from ever achieving the kind of return that traditional high-fee banks historically enjoyed.
But the data is telling a completely different story. It suggests that the digital architecture minimizes operational overhead. There's no expensive branch network, fewer staff per customer, automated processes, all of it allowing them to leverage technology to scale at a fraction of the cost.
That's the cool mechanism. They substitute physical infrastructure and human labor with scalable software. The 31% ROE signals an ultra-efficient business model. And this moves the entire market conversation away from whether neobanks can be profitable to analyzing how quickly other digital challengers must achieve similar metrics just to stay competitive.
So this structural condition customer acceptance, a favorable regulatory environment, it validates this hyper-efficient operation as the new standard.
It does.
Which means that every other financial services company, whether it's regional or global, now has to look at that 31% ROE and immediately assess their own competitive positioning against that new gold standard. It's a powerful validation point.
A very powerful validation point.
That structural validation is the absolute key to understanding the market reaction. If the model works this well for one large player, it tends to raise the tide for structurally similar businesses. So let's examine the first group poised to benefit: Latin American fintech and digital banks.
This is the most straightforward read-through. New Holdings has provided a massive confirmation for the neobank model across Latin America. When the sector leader can demonstrate superior financial health, strong income, and that, staggering 31% ROE, it raises the overall valuation and optimism for any company associated with that same foundational trend.
And what's that trend?
The rapid adoption of digital finance in the region.
So in essence, this performance reduces the systemic risk associated with the entire regional digital finance sector. Investors see NU's success and they think, okay, the market size is real, customer adoption is durable, and the path to profitability is proven. This causes them to look immediately for other entities that can capitalize on those same market dynamics.
Exactly. Beyond NU itself, which is obviously the direct beneficiary, the material identifies two other companies expected to benefit: StoneCo, ticker STNE, and SOFI Technologies, ticker SOFI.
Okay, let's start with StoneCo, STNE. They're heavily focused on payments and financial services for merchants across Brazil. How does NU's consumer banking success directly translate into a tailwind for them?
The connection is all rooted in transaction volume. NU's growth, specifically its strong customer expansion and that increased card usage, it means a larger percentage of commerce in Brazil is being conducted digitally.
Right.
So when consumers use their NU cards more frequently, they're paying merchants who use payment processing systems like those provided by StoneCo. It's a clear, volume-based synergy.
So NU is driving the consumer side of the digital inclusion equation, and STNE capitalizes on the merchant side. It's a powerful cycle where the expansion of digital banking immediately feeds the expansion of digital payment infrastructure.
That's it.
The increase in card-present and card-not-present transactions, driven by NE's millions of customers, directly benefits STNE's ecosystem through higher processing volumes and the fees that come with that.
Yeah.
This reduction in the cash economy is a core benefit for all processors.
And we shouldn't forget that STNE is also expanding its own suite of banking and credit offerings to merchants.
Ah, a good point.
So NU, proving that digital credit risk management and deposit aggregation can be highly profitable, provides a template and market confidence for STNE's own financial services roadmap. It suggests those business lines are now operating within a confirmed high-return environment.
The efficiency standard set by NU is now the target, and STNE is positioned to chase that target using its existing merchant relationships.
Yes.
Now, let's introduce a point of friction here, because the connection to SOFI Technologies, SOFI, is less direct geographically. SOFI is primarily focused on the, very competitive U.S. market. The material suggested benefits here. Is the market really suggesting that a bank's success in Brazil changes investor sentiment for a company in an entirely different market? Or is this more about validating the model on a global scale?
That is an important question to ask, and it is entirely about validating the model, not the market geography itself. SOFI operates under the same defining philosophy.
Which is?
To be a single, holistic, app-first digital bank that aggregates various financial services lending, deposits, investing, and delivers them through a low-cost, technology-driven infrastructure. They're trying to achieve maximum efficiency by bundling services digitally.
So NU's 31% ROE provides this external regional validation that this integrated, tech-forward, low-overhead approach to financial services is capable of generating world-class returns at scale. It's proof that the business architecture works, regardless of the continent.
Precisely. It acts as a global benchmark for digital execution. If a player in a challenging emerging market like Brazil can achieve 40% growth in net income and a 31% ROE using a purely digital playbook, it provides a very compelling proof point for investors in the U.S. who are evaluating SOFI's long-term profitability roadmap.
So it suggests the underlying principles of digital efficiency and consumer preference for simplicity, they transcend national borders.
Assuming the regulatory conditions allow for it, yes. It validates the structural efficiency narrative that all digital lenders are really relying upon.
This means that while SoFi isn't gaining market share in Brazil, its valuation is supported by the fact that the most successful digital counterpart in the developing world is posting returns that even large established U.S. banks often fail to match.
It connects right back to that core concept of low customer acquisition costs leveraged over a long lifetime value via an efficient tech stack. NU proves that LTV can be maximized efficiently, which gives credence to the business plan followed by SOFI.
Okay, moving to our second category of beneficiaries, Latin American digital commerce and payments. This group benefits indirectly, but the link is absolutely crucial. It demonstrates the interconnected nature of these digital ecosystems in the region.
The benefit here stems directly from the shift in consumer financial habits that we see in News Q3 report. Their strong customer expansion, we're talking millions of new users, coupled with the reported increase in card usage, are the most tangible indicators that the public is rapidly shifting toward digital spending across key markets like Brazil, Mexico, and Colombia.
So every time New adds a customer and gets them comfortable using a card or making a digital payment, that transaction volume has to flow through some commercial platform.
That's the mechanism. This rising tide of digital transaction volume provides strong support for any platform that integrates e-commerce, digital wallets, merchant payment processing, and other commercial functions. It's a powerful feedback loop. Well, successful digital banking facilitates greater ease of commerce, which in turn accelerates banking adoption. This structural alignment makes the entire digital economy stronger.
Let's detail the companies benefiting here, starting with the regional behemoth, Mercado Libre, ticker MELI. The material views them as a clear winner.
Mercado Libre, MELI, it dominates e-commerce and payments across Latin America. So if NU is successfully driving digital inclusion and increasing card usage, MELI's core business benefits on two fronts.
Okay, what's the first one?
First, their marketplace sees increased purchasing power and transaction activity because more consumers are now banked and have readily accessible digital credit. The sheer size of the purchasing pool is expanding rapidly.
And the second front would be their payment arm, Mercado Pago.
Exactly. Mercado Pago handles a massive amount of this flow. This integration means that the growth of one successful digital finance entity immediately lubricates the wheels of the regional e-commerce giant.
Absolutely. The success of NU reduces the historical reliance on cash and informal economy transactions, which is a direct positive for MELI's core metrics, specifically total payment volume.
Right. It strengthens the entire digital payment rail upon which MELI's marketplace is built, and that results in higher throughput and higher take rates. The two companies, though separate, are fundamentally enabling the same consumer behavior.
Next up, we have PagSeguro Digital, ticker PAGS. They're more of a pure-play payment platform provider, primarily focused on merchant solutions.
The benefit is similar to StoneCo's, but PAGS has a really strong emphasis on providing solutions for micro, small, and medium-sized enterprises.
The smaller businesses.
The smaller businesses, so more digital cards, higher consumer comfort with spending, and the ability to process payments seamlessly. That means more transaction volume for their merchant terminals and their software. PAGS thrives entirely on transaction fees, and NU's growth signifies a continually expanding and increasingly transactable customer pool for all its merchant clients.
This expansion validates the investment thesis in digital processing for the entire region. The profitability demonstrated by NU suggests that the consumer side of the equation is now fully ready for digitization. And that, in turn, assures investors that the investments made by PAGS in merchant terminals and payment tech will continue to yield returns.
The ecosystem is self-reinforcing. As NU pulls millions of customers into the formal digital financial system, PAGS benefits from the higher velocity of funds flowing through formal commerce channels.
And finally, in this group, we have Despegar.com, ticker DESP, the regional online travel agency. Travel is a high-value discretionary purchase. How does Nubank's efficiency boost travel booking?
Well, this connection speaks directly to consumer trust and financial maturity. High-value digital transactions, like booking flights or hotels through DESP, they require a higher degree of digital financial trust and access.
Right, it's not like buying a coffee.
Not at all. So if a consumer is comfortable managing their entire financial life savings, credit, daily transactions through a transparent app like NU, they are far more likely to commit to large, complex purchases online.
It validates the consumer's comfort level with the entire digital financial ecosystem. When banking is streamlined, reliable, and credit is transparently managed, consumers are more likely to commit large sums to online services like travel booking. And that reinforces DESP's business model.
Exactly.
This makes those high-ticket items, which often define profitability for travel agencies, more accessible to a wider, digitally enabled population.
Financial and commercial digitization are mutually reinforcing. The proof point of a high-performing digital financial player encourages higher transaction throughput across all digital commerce ecosystems, and travel is a key segment of that, particularly in markets where digital trust is still being built.
All right, let's pivot to our third and final category of winners, global payment networks and processors. This group seems to benefit from pure volume leverage, acting as the toll booth for No Holdings' explosive growth.
This is a classic business model. It's structurally designed to capitalize on the success of others without assuming their primary risks. As Nubank aggressively scales its user base, acquiring millions of new customers, issuing more cards, both virtual and physical, and processes a higher transaction volume, the global card schemes and payment processors are the beneficiaries.
They provide the essential infrastructure, the pipes, that transactions have to travel through to clear and settle globally.
Yeah.
So NU handles the regional acquisition, the credit underwriting, the risk management, but every swipe, tap, or online purchase using an NU-issued card requires the network of a Visa or a MasterCard.
That's the key advantage. They capture increased volume and the associated fees without taking on the direct credit risk tied to the underlying loans and cards that NU issues.
So NU assumes the operational expense and the consumer risk in the region.
While the global networks are rewarded simply for facilitating the data transfer and clearing process, it's a risk-mitigated way to gain exposure to the growth of Latin American digitization.
So we are looking at a pure volume play here, leveraging NU's regional momentum for global transactional gain. The entities named here are Visa, ticker V, and MasterCard, ticker MA.
Visa, V, and MasterCard, MA, are the primary global card schemes. Their businesses are inherently leveraged to the growth of digital card usage, no matter where it occurs. Latin America is not only a massive region, but one of the world's fastest-growing vectors for payment digitization.
And NU's growth translates almost instantly into higher switching and processing volumes for V and MA.
It does.
And every percentage point of market share that NU takes from traditional banks, who might be issuing fewer new cards or struggling to digitize, that's a win for V and MA. That market share is automatically captured and funneled through their networks.
Correct. They are agnostic to who wins the banking race, as long as the transactions move through their system. The competition in the region is fundamentally moving transaction volume from less digitized payment methods like cash transfers or proprietary local systems to highly digitized card network rails.
And that is V and MA's primary engine of growth globally.
That secular trend in emerging markets is their biggest long-term tailwind.
The material also includes PayPal, ticker PYPL, in this category. Now, while PYPL sometimes competes with the card schemes, how does NU's success support them?
PayPal, PYPL, benefits from the broad digitization of commerce. While V and MA focus on the card rails, PYPL is optimized for digital wallets, cross-border payments, and secure online processing.
So as digital financial maturity increases in markets like Brazil,
The opportunities for digital processing, transfer, and e-commerce payment integration also expand. NU creates a massive digitally engaged user base, which is fertile ground for services like PYPL.
so an overall surge in consumer digital comfort, driven by companies like NU, creates a more favorable environment for all digital payment facilitators. That includes PYPL, which can integrate into these growing ecosystems for payment clearance or digital wallet storage.
Exactly. The increase in online transaction volume globally, and Latin America is a growing part of that, it benefits them. The contrast in the business models is instructive. NU builds the customer base and assumes the primary risk. V, MA, and PYPL benefit from the higher usage of the infrastructure they provide, whether that's the physical network or the digital processing layer.
It's a lower risk mechanism to capitalize on the structural changes that NU represents.
Mm-hmm.
We've established a very clear picture of the winners riding this wave of digital validation. Now, we must execute the shift and look at those who are feeling the competitive heat. New ending success is defined by market share gains and efficiency, and those gains have to be extracted from the established players. We start with the most affected group, traditional Brazilian retail banks.
This is the competitive epicenter. Nubank's entire structure, its scale, combined with a purely digital, low-cost operating model, is expressly designed to continuously peel away customers' deposits and revenue streams from legacy banks. They are losing the battle on both customer acquisition and cost efficiency.
And the challenge for these incumbents is immense. I mean, they're weighed down by decades of accumulated overhead,
Oh, yeah.
massive physical footprints, the cost of maintaining hundreds of physical branches, large staffing levels associated with those operations, and historically they relied on charging higher fees and having less transparent fee structures just to offset that massive fixed overhead.
And that structural discrepancy is the very source of the competitive strain. When NU delivers a 31% ROE with a low fee model, an efficiency that is just unmatched by the incumbents, it forces those established banks into an untenable position.
They're typically growing at a slower pace.
And they are acutely vulnerable to margin compression. They're forced to reduce fees to retain customers, but their high cost structure prevents them from achieving NU's margins. This means every retained customer potentially costs them more in terms of profit.
So they're caught in a classic structural squeeze. Reduce fees and hurt your margins, or maintain fees and lose customers to NU.
That's the truth.
Who are the key names feeling this pressure in the Brazilian market?
We are specifically looking at Itaú Unibanco Holding, ticker ITUB, and Banco Bradesco, ticker BBD. These are the financial titans who define the legacy banking landscape in Brazil.
And the challenge for ITUB and BBD is not just about keeping up. It's about unwinding decades of investment in physical infrastructure. How can a bank like Itaú, with its extensive branch network, possibly achieve a cost-to-serve ratio that competes with a pure-play digital entity generating a 31% ROE?
It's almost impossible without immense disruptive internal restructuring. Their physical footprint is no longer primarily an asset, it's a massive fixed liability.
Right.
It's absorbing capital that NU can instead reinvest in technology and customer acquisition. ITUB and BBD face very difficult, very costly decisions. Closing branches, implementing multi-year, multi-billion-dollar internal digital transformation projects, and aggressively cutting fees just to slow the customer drain.
And all of those actions negatively impact their short-term and medium-term profitability and growth rates compared to the fintech challenger.
Absolutely. And furthermore, NU's success validates that the market preference has shifted decisively away from the legacy model towards speed, transparency, and low cost. The incumbents are paying the price for the maintenance of an outdated structure, struggling to keep pace with an entity growing income at 40% year over year.
That's the entire point.
Yeah.
NU's efficiency sets the market price floor and the service expectation ceiling. Every quarter that NU posts numbers like these is a quarter where the structural handicap of ITUB and BBD becomes more pronounced, requiring more urgent and often painful defensive moves. Our second category of losers are global banks with slower digital execution in Latin America. Here, the pressure seems to be more about relative performance and opportunity costs for global investors.
Absolutely. The 31% return on equity delivered by NU is such a powerful figure that it sets an extremely high-performance benchmark for the entire region. When an agile, digitally native bank achieves that level of efficiency, it exposes the relative underperformance of slower-moving, cross-border banks operating in the same consumer segment.
So it's not necessarily a crisis for these global institutions, but it's more of a harsh spotlight on their operational inefficiency and their lack of regional agility compared to NU.
Yes. They look less appealing on a relative performance basis, especially since they're often trying to serve multiple continents at the same time.
Right.
These slower-moving cross-border banks, those that might be digitally transforming but aren't focused laser-like on the mass-market consumer segment in Latin America, or whose global complexity slows their regional innovation, are now seen by the market as less attractive capital destinations. They're moving at a different, slower pace, which is proving costly in the eyes of investors who are benchmarked against NU's returns.
And which specific cross-border banks are facing this scrutiny?
We're looking at Banco Santander, ticker SAN, and HSBC Holdings, ticker HSBC. Both are massive international financial institutions with extensive, complex global operations, often including, footprints in various Latin American countries.
Yeah. The sheer complexity of running a global operation like SAN or HSBC becomes a weakness when you're competing against a nimble, regionally focused player like NU.
It does.
They have to deal with dozens of regulatory environments, legacy IT systems inherited globally, and often competing internal priorities that prevent them from focusing 100% of their resources on dominating the regional mass market digitally.
That global complexity severely hampers their ability to replicate NU's laser-like focus on regional digital efficiency, which is why NU can generate a 31% ROE. A bank like SAN or HSBC simply cannot match that regional agility or that return profile, particularly in the mass market consumer segment where NU dominates. Their capital is allocated globally, whereas NU's capital is allocated for maximum regional effect.
This contrast really emphasizes the penalty for lagging in digital adoption. The market essentially says if a high-growth sector in Latin America is delivering 31% ROE via NU, why would I invest in a slower-moving bank that is achieving a fraction of that return in the same region?
It's the opportunity cost of capital. Capital is mobile, and the proof of NU's performance makes the relative performance of these global slower movers look unattractive. They have to accelerate their regional digital strategy or face continued market skepticism regarding their ability to compete effectively in that high-volume, high-return consumer space.
Finally, we turn to high-fee consumer and store card lenders. This pressure transcends Latin America. It's a thematic competitive challenge based on this new global standard for consumer credit transparency.
This is where NU's operating model serves as the disruptive force on pricing and user experience globally. Nubank's strategy, a low-fee, mobile-first, and highly transparent approach, is establishing an elevated competitive standard for consumer credit products worldwide, not just in Brazil.
And consumers everywhere are becoming accustomed to credit products that are cheaper, transparent in their terms, and exceptionally easy to manage via a mobile app. This habit formation directly undermines the business models of lenders whose revenue streams have historically relied on opaque fee structures and less consumer-friendly experiences.
The consequence is a market-wide competitive strain. Lenders whose profitability relies on higher late fees, complex interest calculations, or difficult-to-navigate user interfaces are increasingly disadvantaged. Once consumers experience the simplicity and low cost offered by modern digital banks, their tolerance for outdated, high-cost offerings just plummets. This is a global psychological shift.
So the pressure on these players isn't necessarily about market share loss to NU specifically, but it's pressure on their ability to maintain high margins in the face of rising customer expectations for digital excellence and low cost.
That's it.
Which specific U.S.-focused lenders are identified as feeling this margin pressure?
We are looking at Capital One Financial, ticker COF, and Synchrony Financial, ticker SYF.
Capital One, COS, and Synchrony, SYF, are major institutions in the U.S. consumer credit and co-branded or store card space. While they are geographically separate from NU's core markets, their profitability is directly challenged by this thematic shift toward digital transparency and low-fee credit products.
Right. They have massive existing portfolios that now must be managed in an environment where the competitors' cost of capital and cost to serve are dramatically lower.
That's the critical link. Synchrony, for example, is heavily reliant on co-branded store cards, which often carry higher interest rates and more complex fee structures compared to general-purpose cards.
They do.
So if the global benchmark for quality consumer credit is shifting decisively toward the low-fee digital transparency championed by companies like NU, then COF and SYF are forced to accelerate their own digitalization and potentially compress their margins to compete with new digitally native entrants that are constantly lowering the cost of credit.
NU has weaponized simplicity and low cost, and in doing so, they're threatening the very foundations, the fee structures that underpin the legacy revenue models of these lenders. They have to worry about the next domestic USNU equivalent, whose path to profitability has just been powerfully validated by that 31% ROE figure.
So the focus for these companies shifts entirely to defense.
Defense of their margins and defense of their customer experience against the elevated standards set by global digital leaders. Their ability to generate profitable growth is constrained by the knowledge that high returns, paired with low fees, are now possible.
We've spent considerable time examining the dual effects of New Holdings' exceptional Q3 report, the structural validation of the winners, and the heightened competitive pressure on the incumbents. Let's synthesize the broader implications of these earnings.
The NU earnings report confirms a powerful, overarching theme. High growth, highly profitable digital financial services are not an anomaly across emerging markets. They are the new standard. The results confirm that superior returns, scale, and high efficiency can and are being achieved simultaneously within this new banking paradigm.
So for anyone tracking this space, this single earnings report provides a crystal-clear method for assessing the current competitive landscape across regional and global financial service companies. You now have a tangible metric, that 31% ROE, to use as the benchmark. Who is riding the digital validation, and who is structurally vulnerable due to high costs, slow execution, or a dependence on fee structures that consumers are actively abandoning?
You see the dividing lines drawn starkly. The winners are those who are natively digital, those who serve the commercial ecosystems that enable that digital finance, or those who own the volume-based infrastructure.
And the other side.
Conversely, the companies that are struggling are those burdened by physical overhead, moving slowly on digital execution, or relying on high-margin, opaque fee models that are being aggressively undercut by highly efficient, transparent competitors.
The performance gap between the old banking model and the new one, validated by NU's 31% ROE, is enormous. And this brings us to a final thought for consideration. Given that a superior return on equity can be achieved by a digital bank that successfully competes on low fees and hyper-efficiency, what remaining competitive advantage is left for the legacy branch-based model in consumer banking if they cannot execute a rapid and deep transition to a comparable digital cost structure?
The clock is ticking on high physical overheads. Maintaining a costly branch network now carries an undeniable opportunity cost, measured precisely against that 31% ROE benchmark.
That concludes our analysis on the market reaction and competitive implications stemming from New Holdings' record Q3 performance. Thank you for joining us on Breaking News to Trading Moves.
Please note that this discussion is not financial advice or a recommendation to buy or sell any of the mentioned securities. This analysis is purely the opinion of the author of the material reviewed.
Thank you.